a 4-week series of all things blockchain. So we started from the basics, then we went to how to invest, crypto wallets, and then we went to NFTs last week. And today we're going to wrap up with DeFi. Just a few quick housekeeping things. Our toilets are just at the back. If you keep walking and turn left, you'll find them. In case of emergencies, we've got 2 fire escapes where the mural is and on the other side where the bathrooms are. And yeah, if you guys want to learn more about what we do at HHQ, especially if you're a startup founder, you can come find me after the event. Otherwise, I'm going to pass it on to Daniel, who is an expert. He's a good friend of HQ. Today he'll be going over DeFis, what they are, how to use them, and some product demos and use cases and stuff. So hopefully you guys will enjoy it. We will be recording as well, so for any info, we'll send it out afterwards. So cool. See you guys.
Cheers, thanks Isabel, and cheers everyone for coming. Yes, it's like crypto must be interesting enough because people come in after work late and invest their time, so there must be something to it. And yeah, I hope we'll learn something new. And as I take it, session number 4 means that everyone is an expert now. So like by no means I'm an expert. Everyone's like co-learning together. Maybe I'll ask some of you guys for expert advice here. Maybe if you guys want to volunteer, just like share the key highlights, what has happened in the first session, so that I'll gauge the kind of content that I'll be sharing. So who has attended all of the 3 previous sessions until now? All right, solid. Brandon?
Yes.
What did you learn?
What did I learn? I think it was pretty good in the first one. Terry knows his stuff in the crypto space for a while, but it's just good to hear about how crypto is far bigger than Bitcoin. I think everyone thinks Bitcoin is all crypto is, and just to see how the application can be so wide and how far it's spread, so it's pretty fascinating. Obviously with Gem last second week, it's pretty good learning about wallets and how they can be applied and how we can take it offline. So, look, I mean, it's been pretty broad, it's been pretty good. And Terry from the beginning was saying, if you look at DeFi, it's, you get into too much information, saying that you've been talking about at the end. So I think it's one thing that's by myself, and I think I myself been very, very interested in.
So in wallets, did you use MetaMask or which wallet?
MetaMask.
MetaMask, okay. So everyone kind of feels comfortable using MetaMask? Maybe raise your hand if you're less comfortable using MetaMask.
But that's great.
I've used it for a while.
Yeah, hope you have your keys. All right, because I'll assume that everyone knows how to use MetaMask, but if for whatever reason someone wants to stop and review it, so we can take a moment to review. So just for how it looks like, you have, I'm assuming that you guys downloaded a web extension that you can click and it will pop up and show you somewhat of your holding, and you can generate wallets, etc. And this essentially is turning web pages into decentralized applications. So if there is a decentralized application on web version, you'll be able to interface, interact, sign messages, transact, all that stuff with this web extension. And that's probably the most user-friendly version for Ethereum specifically. So for other networks, maybe you'll end up using different wallets, but yeah, that's the one that I'm assuming that Gemma has taught all of you how to use. And yeah, for today's session, what I figured would be good to cover is some real examples for how do you catch some alpha. So how can you get some interesting yield farms or use some DeFi products to invest through. I saw somewhere in the advertisement of the event that how to invest your first $10. So I don't know if this has been covered already, but gas fees price of today, $10 is not even enough to start. So Ethereum kind of became a little bit expensive, and if you want to invest $10, then probably some of the other chains are more relevant, and maybe we'll cover it in the next series that Terry will start. But yeah, in this one, unfortunately, the cost is going to be quite high, so it can actually end up in the hundreds of dollars for some transactions now, and that's actually that's hindering some of the development and actually pushes back some users that otherwise would not feel comfortable with spending so much money. On the other hand, there's other networks that are much more cost effective that are succeeding because of this market gap, such as Binance Smart Chain, which is EVM compatible, which we'll get to another time. So I guess, has any of you tried out Uniswap before? Yes, a little bit. Does any of you, so raise hand if you have any ETH. Okay, some. Okay, raise hand if you have any other token that is on the Ethereum network. Okay, so if you have Ethereum and you want to change it to another token, whether it's to speculate or to use, you might want to do it through an exchange, and probably from a UX friendly perspective, Uniswap is the most widely used exchange. So if we're not talking about complex new stuff, I'd suggest using Uniswap. So let's take a look at what's up there. Generally speaking, it's highly recommended to bookmark your links, because sometimes someone can change the link with just like one letter of difference that looks the same, and then you end up signing a transaction and it might not be exactly what you thought, and someone drains your wallet. So yeah, just basic things to be careful. So yeah, I guess like this is a pretty simple interface which allows you to choose the token that you start with, the token that you want to change to. So whether it's I want to change to Aave, and let's say 1 ETH, I'll get the rate, I'll swap, and it tells me some really interesting stuff. Let's like review a little bit of what it says, because this reveals some interesting financial opportunities. So what it tells me is you'll swap 1 ETH for 6.4 Aave, and it tells me that there will be 0.03 ETH liquidity provider fee. That's on top of the gas fees. Does anyone understand what it means? What do you understand?
Liquidity provider fee.
Yeah.
So it's the fees that go to people providing liquidity in our trading pool. So the ETH to RV trading pool, they've deposited both ETH and RV together, and they collect fees from people that are trading between those two tokens.
Yeah, this is really interesting. Reason being that if you're looking at traditional exchanges, the way that they work is that you have market makers that provide the liquidity, and they're the ones that collect fees. In decentralized exchanges, which is one of the most basic primitives in DeFi, you have the ability for whoever, permissionlessly, people, provide liquidity and act as the market maker and collect fees. So the reason it's interesting is that if you look at the fees here, you can start thinking, oh, maybe instead of just being a hodler, having you know what is hodler, yeah? Okay, so Terry did good work. If instead of just being a hodler of say like Bitcoin and Ethereum, what you can do is go to pool and add liquidity, or in case of what we have here, I prepared an example of Bitcoin and Ethereum. So there is the wrapped Bitcoin, which is the Ethereum version of Bitcoin, and Ethereum and ETH. So those are the pair. I have deposited some, and you can basically see what is it that I have earned. My pool share from this liquidity pool is 0.02%, and let's see. You can basically see see the analytics performance. Earned fees $130. It's obviously converted from the today rate of BTC and ETH. But yeah, basically you can see how instead of just hodling, I can also be a market participant, and this is one of the most simple way of participating in DeFi. Make sense? Questions, anyone?
Yeah, but you're selling one for the other. So if you start with Ethereum, you might end up with all Bitcoins.
Good point. Basically, you're providing liquidity to both sides. In the case of Uniswap, there's other decentralized exchanges where you can provide single-sided liquidity. But for this one, you provide liquidity both sides, and you might end up increasing one or the other depending on the market dynamic. Yeah, absolutely right. Yeah. So that's why, like, this is a risk that you're taking as the liquidity provider.
That's why you get the fee.
Like you get the fee from every transaction.
Is it worth? If Ethereum goes up a lot, then you might sell over Ethereum and get all the Bitcoin. The Bitcoin might be stable.
Yeah.
It's Amazon all the.
Yeah, very true. In the case of Ethereum and Bitcoin, both of them are assets that are like the most popular assets. So that means that they have the deepest liquidity typically, and your risk is also lowest, right? Like the kind of loss that you may incur is slightly smaller than in other assets. Now, this question leads to a very interesting thing, which is, anyone heard of yield farming before? Broadly speaking, you seem to be like switched on. What did you hear about yield farming?
Yield
I
farming. Oh, sorry.
Sorry, I heard that, but I don't completely understand it. It's like once you provide liquidity, you can still keep making money off that, other than the transactions.
Yeah, what did you have in mind?
Similar.
All right, so, gentlemen, what's your name?
There's Tabos.
Staples?
Tabos. TABOS.
Tabos. So Tabos was alluding to a very interesting point, which is if you are a liquidity provider, you might end up losing some or basically like being on the side of the market that is not favorable. And in the case of Bitcoin and Ethereum, the risk is low. But then comes a question of what happens if I want to provide liquidity for a new asset, say a new token that was recently launched and doesn't have so much liquidity. So I'm taking on a lot of risk because this asset has, there's a lot of uncertainty if this project will succeed. Maybe it's a scam, who knows what, right? So then one of the ways that teams are incentivizing people to participate is by doing yield farming campaigns. And what it means is that you'll provide liquidity, you'll earn the fees just as we saw in this example, as well as you'll earn on top of that very high yield. So one way to find those opportunities, let's look at CoinGecko Farms. Tornado.cash is actually interesting. We'll get to it hopefully today. Top yield farm of the value. So you can go to CoinGecko and you'll find the most recent popular yield farming activity. And what happens there typically is basically you'll see a token that you might not know so much of because it's a new token, or in that case it's a token probably that exists already over half a year, which in crypto terms is very long.
Sorry, can you just zoom in a little bit?
I am sorry. Yeah, so in this list, you basically will see the risk that Tabos was alluding to is called impermanent loss risk. It's basically you're gonna lose some of your value there because you're switching from one asset to the other because there's more demand to the asset on the side that, of your pool. So that's the impermanent loss risk. And the other thing that is important for people to show is the APY. So basically how much return you'll get per year. And here you see, okay, like 4% not really interesting, 19% slightly more interesting. Oh, 144%, this is really interesting. So you have basically Sushi Swap, which is kind of like Uniswap, it's a decentralized exchange, is trying to incentivize people to provide sushi and wrapped ETH. For whatever reason, they decided that they're going to reward people with sushi tokens. Yeah, there's a lot of food in DeFi. Sushi has been like one of the most popular foods. So yeah, this is just like a brief kind of cover on liquidity provision. Now, this is super at the high level. We didn't even discuss any product here. So I want to show one example for hedge and how liquidity provision is playing out there. So hedge is quite a sophisticated product, and let's see, let's start and see how far we get there, and see it from the angle of liquidity provider and staker. Anyone heard of hedge before? Yeah? Try it out?
Yeah, I looked at it, yeah. Interesting.
Okay. So hedge it's a marketplace for hedge strategies. So people can come in permissionlessly and start a pool. They'll basically manage a portfolio, and someone can invest in their pool permissionlessly. So you don't need to know each other, you don't need to have a legal contract between one another, and you'll be able to basically get exposed to the performance trading strategies that the pool manager is executing, and they'll collect some management fee. This is very similar to how hedge funds works, but it gets a little bit more interesting. The hedge platform is also rewarding performance mining. So for top managers and also those that invest in top managers, they give performance mining of 25% annum in DHT. So DHT is the native hedge token. So you see this little icon shows that this pool is eligible for performance mining. And one of the interesting things about hedge is you can basically take a look at the position of the portfolio composition that they have at every moment. You can take a look at the historic trades by looking at the activity. You see, like, they sold Link to SUSD, or they got from ETH to SUSD, or Link to DOT, and you can either just review it so that you know if you trust them and if you want to invest in them, or you can review it so that you kind of like learn about strategies and their mental models. Some of them are also sharing posts. Sometimes the posts are only public, only available for those that are invested in the pool. So you need to have pool tokens, similar to how you would have access to investor briefing if you'd be a limited partner in a fund. And now the interesting thing is hedge is built on synthetics. Synthetics, anyone heard of before? So synthetics, one of the most relevant assets in synthetics is the SUSD stablecoin. And because synthetics wants to encourage people to use SUSD, so they propose to do a liquidity incentive program with hedge, where people that provide SUSD and DHT liquidity on Uniswap will be able to not just get the liquidity provider fee, which we've seen in the beginning, but they will be able to also get extra reward of DHT and SNX synthetic tokens. So the way that it would look like, I hope that I have the right account logged in, but you have different kind of rewards exposure in hedge. So let's look at DHT staking. It will probably show us everything. Yeah, actually this is DHT staking, so it's different example. Let's see. Let's see another. Liquidity provided, right? Right, so yeah, I prepared a little bit of liquidity so that we can show basically what you get here. So you provide liquidity on Uniswap, and when you provide liquidity on a decentralized exchange pool, what happens is that you're depositing two assets, right? We said in this case DHT and SUSD. Let's maybe like open a Uniswap tab so that you can see. Yeah, actually the reason you don't see it, we'll get into it in a moment, but let's say that, let's try to like go over the motions. Yeah, so you're preparing basically those two assets to deposit, and then you start by putting something, assuming that I actually did it. I currently don't have SUSD in this account, but let's say that I did. I go and I process this transaction. What ends up happening is that I'm receiving in return tokens that are representing my portion of the pool of liquidity here. Make sense? So what DHedge and Synthetics did is that if I own those tokens, I can come and basically stake them in this new DApp, and it will start accumulating DHT and SNX tokens for me. And the DAO is actually like, you guys covered DAOs before in one of the sessions. The DAOs, most of the DeFi applications have like a community that governs the application and decides what kind of incentives to put and what kind of roadmap do they want to see in the product development. So the DAO decided to allocate a bunch of the treasury, a bunch of the budget that they have, to those incentive programs. So currently this program is running until I think some point in May, and there's discussions of potentially extending it.
So is the purpose of this getting people to stake their liquidity provider tokens so that they don't pull out their liquidity? Is that the whole reason for having this staking mechanism, so that the people with those LP tokens are incentivized to keep the liquidity in the liquidity pool rather than pulling it out?
Pretty much. Yeah, like, you could otherwise, it would be very complicated to do it directly on the pool. So it's a mechanism to basically like see who went through the extra step to get this alpha.
And is there a lockup period for these LP tokens, or can you take them out anytime?
On this specific program, there isn't a lockup period, and the moment you unstake, you basically stop earning the reward. But it's a good question. Some staking programs have lockup periods. There was actually an example I want to show. Stakingrewards.com. Anyone knows this one? So for some of the programs, if you are staking, you have a lockup period. In the Polkadot ecosystem, this is very normal actually. You have basically, you bond your assets, and you have that lockup period that you can't unbond them before. And yeah, the reason is to basically take them out of circulation, and by that make it into a part of the flywheel and utility. Cool.
But what is your risk in this one? Because it's
Yeah, good question.
It's nice, 10% per month. So,
Yeah, 100% is nice, right?
yeah.
This gives you an indicator that it's likely that these assets are slightly riskier than something like ETH and Bitcoin, right? Because if you look at the liquidity depth, so DHT is actually not very liquid assets. You have like, let's see, like purely from volume, like super high general overview, right? You look at an asset and take a look at the daily traded volume. So traded volume is $2 million, right? It's not really huge, right? Compared to bitcoins that you have like in the orders of like multi-billion dollars, right? So for you to provide it, you're basically taking risk that if you want to get out to stablecoin, there will be enough liquidity. Because also your earning is proportional to your deposit, right? Make sense? And assets are like very volatile. Basically, now we're at the kind of $3 something. The last month there was $5, so it's very, very volatile. So maybe another example for like in DHedge, there's so many rewards programs that it's just a good example to go through. There's also staking. So the way that the platform is governed, because it's a decentralized application, is by having voting power allocated to people that are staking tokens long term. And what you see is that if you want to stake, you will have voting power proportional to how much you stake, and also proportional to how much lockup period are you happy to commit to. So just for the fun and being adventurous, I locked up for 3 years, and very speculative. And by that, basically, I get the highest APY. Now it's 53, but when it just started, it was, I think, around the 250 or close to 300. So from what I staked here, let's see, I staked 10,000 DHT. How much did I get? I got reward of 400. Oh, actually, 400. And it's, I think, maybe like 2 months or something. So then it becomes a question of like how much speculative appetite do you have, and also what's the price. When I was staking, the price was much lower, so I was like, who cares, right? Now it's like, this like 10K DHC could have been worth something, right? So
at this stage, could you restake that amount, the rewards from there?
I can claim it and restake it.
At any time?
Yeah.
Okay, so there's no minimum?
There's no minimum, but this is a good question, because let's say like if I do want to claim it, then it's gonna cost me in gas $89 worth of ETH, right? So it's gonna make me think twice, what do I want, like when do I want to claim? I wouldn't claim like every day, right? It wasn't exactly like that before, so like when, I guess like every so often it would happen that there would be something that takes the network congestion to new highs, but then it would go down. Now, because we're in a super cycle rather than a bull market, at least this is like what myself and other people believe, so it just doesn't go down, it's not going to go down, and what we'll see is more network adoption in other networks that would complement the need for activity on blockchain, public blockchain networks. So it's kind of, we need to be in peace with the fact that Ethereum currently is a little bit of a premium, kind of like what Apple was until it became more commoditized. Like having an iPhone was something that only a few people could have, and now everyone can have. So we're kind of in that phase of where Ethereum is, that it's, some people say it's like the chain for the rich, I guess, or those that got early enough. Yeah.
Can I ask a question?
Yeah.
Won't that problem go away when they move up to proof of stake?
Potentially, that's one of the options. Yeah, like proof of stake, or if you have side chains. So some of the DAOs that I mentioned, DAOs are often including a lot of on-chain activities, and some of the DAOs became totally not viable. And what they did is they moved to XDAI, and XDAI, the native gas token there, is basically a stable coin, so it's like fractions of cents, and it's not a proof of work, it's proof of authority, which is kind of like proof of stake. And yeah, it's very cheap to operate. However, you're trading security, right? You're trading security for performance. So, yeah, but we'll see. And a lot of people like are quite happy with this trading security for performance. Otherwise, Binance Smart Chain would not be so successful, right? So, yeah, any questions before we move on to something? Maybe someone wants to share some adventures they had in DeFi products.
I was hearing like yield finance actually has a really high interest rate. Like how do they end up, like how do they give that interest rate? I don't really understand how earn that much if you
Yeah, I haven't participated in yield finance, but I know that one of the things they did in the early days is that there was very, very high APY, so that they would get network to bootstrap. And actually they got into a problem where they spent all of the year, like all of the Wi-Fi on those early miners, and then it became a problem, and most recently they passed a vote to mint more. So everyone can be like a central banker that prints more money, basically. If you have like the right justification and people still believe in you and stuff. Yeah.
So is that the case that most of these really high APYs are generated by different protocols paying you in their own native token, which may or may not have value at a certain point?
Yeah, pretty much. So often what happens is that, as I mentioned, like when projects are just starting off, they want to encourage people to get adoption, so they would allocate, say, like 1% of the entire tokens in circulation to be distributed across the liquidity providers through a yield farming campaign over a period of, say, like 3 to 6 months or something. So you get quite high APYs there, like unless there's a flood and someone just takes it all. And then there's also risk. Sometimes scammers come and say, wow, we have like 1,000% APY on this hot project, and then they do a rug pull. So I don't know if you heard about that one, but basically it's taking advantage of the impermanent loss, right? If someone provides liquidity and then someone sells from the other side, they can end up with the worthless tokens and someone else drained that ETH, if it would be like ETH or stablecoin. So when you have like a very high APY, you want to be quite cautious about what you're getting into. It's not to say that those things don't exist, but you just want to kind of do a bit of research, and generally like not just set and forget. These things are often in the orders of like weeks and then they're gone, right? So you want to be sure that you've caught your alpha and it's worked for you, calculate what's the risk parameter you're comfortable with, and get out.
So what currency is the APY calculated in? Is it referenced against US dollars or ETH, or only in the native token?
Mostly in that specific token that is being rewarded. So
Okay.
like here it's in DHT.
Right.
Yeah. Cool. So there was another couple of examples I wanted to go over. One of them is privacy. So all of you guys have wallets by now. So something that you may have noticed, did you use Blockchain Explorer, etherscan.io? So everyone can basically see all of your transactions, and your privacy is getting exposed, right? That's fun, right? But it's also problematic. I'll show you a couple of examples for where it becomes problematic. So we have this project called DeepDAO, and what we do is doing some social features and analytics for the DAO world. And one of the products that we have here is people. So what you can see is that you can see the people that are members in DAOs. You can see what DAOs are they a member of when it's loading. And all of this naturally is based on their publicly available Ethereum address we're now also adding Kusama and Polkadot and other networks. And you see at the last one here, AUM. So AUM is asset under management. And how do you feel if your profile would be shown here and all of your tokens holding and your transaction history would be shown here? A little bit less comfortable, right? So we actually already have this product on staging environment, and when we did user testing, without any outliers, everyone was like, "Oh shit! Like I don't want to have my data exposed like this," even though it's publicly available information, right? There were one or two perverts that said like, "Yeah, we should show it. This is awesome and stuff."
Well, the API is publicly available. You can't pull it unless you can actually code to actually pull the data out. Like, it's not that easy to access.
It's more easy than you can imagine. Think about it. Like this guy has his profile is integrated with his Ethereum address, right? You just take this one to either etherscan.io or Zerion or something. You'll see all of these token holdings, transaction history, etc. Right? Obviously, some people have more than one address. But you'll be surprised at how much information you're able to get.
Yeah. How do you link the wallet address to the person?
Yeah, so this is specifically what we see here is integrated with 3boxDB. 3boxDB is an identity provider that the users had to opt in. And then what we did is just integrate it into this interface. And the thing is that now we're integrating a bunch of other identity providers. And we're also, yeah, this is like some not yet public information, but we're going to incentivize people to enrich their profiles. So they will want to add, whether it's social proofs with Twitter accounts, or you want to add more than one address, all those things. And there's also a rationale for why you actually want it and you want to share things. And you'd want to maybe have multiple accounts, one that would be like stash accounts that you don't share publicly, but some others that you do, just like social media, right? So you don't share like your medical history on Facebook or LinkedIn, but generally speaking, you do share your employment history on LinkedIn because you want to be recognized for your previous work achievements and stuff like that. So there is a case for privacy and there's a case for public information being available. There's just like, we're still at the early stage of understanding what does public or private mean in a Web3 environment. But generally speaking, I'd argue that privacy is still not sufficiently prioritized in Web3. And this is where projects like Tornado, I think, are really interesting. I forgot to give the disclaimer. Nothing that we're talking about here is this like a investment advice. So just like if you're investing in anything after this talk, it's like your own reasons. Of course, like it's always good time to get into crypto because it's still early, but generally speaking, have your own thesis for what assets you're buying. So one of the really interesting applications on Ethereum is called tornado.cash, and it's a mixer. Does anyone know what a mixer is, or how does it work, more or less?
Something that sort of mixes the transactions to make it more difficult to see who's doing what.
Yeah, actually, let's try to like whiteboard it a little bit. Yeah. So one of the problems, as we discussed with public blockchain, is that all of the transaction history is public, right? And you can't really do something without it being accessible. So for many organizations, this is really problematic. Like if you were to run a commercial organization and all of your payroll is there, or suppliers payment and stuff like that, then your competitors can come and see it, and basically they know what's on your balance sheet, and maybe they can strategize something to take you out of the market. It basically becomes problematic. So one of the ways to solve it using blockchain technology is using mixers. So the way that mixers work, it's actually functional. Okay, we'll get shortly another one. So the way that it works is because everyone has public addresses, so what we want to do is okay, we'll get there at some point. Okay, that's good enough. So we want to build a device that basically disconnects from the inputs and outputs of, like from the deposits to the withdrawals. So the way that it works, without getting into the fancy zero-knowledge proof technology, is that it accepts deposits in only a particular denomination. So let's say that you can put 0.1, 1, 10, or 100 ETH. Right? And then you'll be able to also withdraw only 0.1, 1, 10, or 100. And then, ignoring for a moment how it actually works, that it shows that you're entitled for withdrawal. What it means is that if there were all the deposits were of one size and all the withdrawal of one size, you won't be able to know which one correlates to the other, right? So that's more or less how the mixer works. Now, some of the problem that happens here is that when you deposit into the mixer, you're basically going to park some capital in, and in order for this to work, you're going to need to wait for a sufficient number of deposits after you for it to be disconnected from your deposit, right? So I mentioned the case of organizations that have a payroll and they don't want to expose their commercial activity. But actually also other people that are abusing this device are hackers, right? Hackers come and they steal some money and then they want to anonymize it, so they go through a mixer. So there's the case for why this is like an evil technology, and there's the case for why this is amazing technology. Typically, each of us make our own case for depending on our where we come from. So when I speak to bankers, often the only thing that they can think of is how it's like used for illicit technologies, and when we speak to privacy fanatics, it's for good reasons. Yeah.
Is the mixer program on chain? Because if it's on chain, surely it can't be very. Someone could work it backwards, figure it out. What the.
It's on chain, but it uses some fancy technology called zero-knowledge proofs, ZP snarks, that helps make it very difficult or impossible to. Yeah. Let's work through the thing. Like I just wanted to get the idea of how it works, and now let's see what's really interesting in it. What we understood so far though is that in order for this to work, you'd need large number of deposits, right? That makes sense so far, yeah? And then the question becomes, from an incentive design point of view, how do we encourage large number of deposits? And this is where DeFi and deal farming, and in that case anonymity mining, comes to the rescue. So let's see. Okay, so I connect my wallet. I don't know why Twitter goes here. So as I mentioned, basically, when you deposit, you can choose the. take me to the Twitter. I think I know. Should be okay. Okay, so when I deposit, you can see the anonymity set. So anonymity set is how many people have deposited so far, and then I would know when I deposited what's my number and how many were after me. So if I care about the anonymity, I'd wait, say like at least however 10, 20 or 100 depending on how much I care about it, and then I withdraw it. And the way that you make it untraceable, to your question, so you'd receive a note, and that note is generated on the device. So it's not something that is on chain, it's actually like on the machine. Yeah. And I'll need that note, like this note will be a part of the signature that goes through a hash function. So hash function, maybe we'll get to another session. But basically, it allows me to withdraw it only if I have that note, because this decrypts the signature. So I'll be able to basically like record it on my device. I'll keep it encrypted on a strong box or whatever it is that you use, LastPass, something like that, used for encrypted notes. And then you can also send it. Like I actually heard about quite a few crypto organizations that are using Tornado to pay staff. So what they do is they actually send notes. So they have pre-deposited a bunch of ETH on Tornado, and then when they need to pay out, they basically send people notes as a kind of redemption coupon from Tornado. So now that we understand more or less the concept of what's the things that we can do with Tornado, I don't want to actually do a deposit right now. There is something really interesting. When we discussed yield farming, so we were thinking about just providing liquidity on a decentralized exchange, which is kind of a Degen use case, right? Because there isn't so much of a contribution to an application, to a real use case. It's more just like trading. It's a fair use case, but it's quite primitive. Now with Tornado, something that we can do is we can generate notes that show the maturity of our deposits. So essentially, like we are liquidity providers to the mixer, right? And then, depending on the maturity, we can harvest for yield farm, something like yield farm, anonymity points. And the Tornado DAO has defined a portion of the DAO tokens in the treasury to be distributed across those that provided liquidity and earned anonymity points. So this is one way of yield farming by supporting privacy online. So that's already like when you see that yield farming is used for very creative purposes. And this can also be created in a circular fashion. Basically, the DAO can decide, all right, from any profits, because this application generates fees to the DAO, from any profits we can buy back some of those tokens, and by that we'll continue this incentive program in perpetuity, and kind of created a primitive that can be integrated as privacy enhancing piece to different applications. And right now it's, I'd say, relatively early. Very few people are interested in privacy. I think most of it is not because it's not relevant, it's more because the implication of not having privacy are still not fully digested. And I think that as we progress with adoption of crypto technologies, it's going to become very widely understood why privacy is really important. And technologies like Tornado are going to be more widely integrated into other products. Any questions?
This can also help avoid tax, right?
I'm not a tax advisor, but if you have some ideas, then Emily could be someone to discuss this after the session.
Do you know anything about tax?
I
It's
know
just
that-
that this is so unprecedented.
Yeah.
What happens after you've bought and invested?
Generally speaking, if we're talking about Australia, so the ATO has very clear guideline actually on different cases, like whether it's Bitcoin mining used to be a case, or ICOs or trading. All of them have like rulings already. Maybe some of the newer programs like yield farming is something that is not entirely well defined yet.
Is this found on the website, the ATO website?
Yeah. They have like already, like I remember seeing one of the papers that they wrote in 2017 or 18. It was very comprehensive. Yeah. Generally speaking, like for the simple use case of buying and holding or trading, so it's treated just as foreign currency or stocks, right? If you're buying a Bitcoin and it appreciates from 10,000 to 60,000, and then you want to sell it, so there's capital gains tax. If you're doing it as trading, so it's income. There's all the use cases and the intentions and how you do it is what defines the tax. But again, like I'm not a tax advisor, so you know, have a chat to your whoever is doing tax for you, and you can refer them to the ATO documentation. Iggy.
How are you? How did the stablecoin in your mind being $350 listed on the stock exchange is driving this other like all the other smaller guys?
Sorry, what is stablecoin you saying?
Stablecoin has been listed, as you know. in
Stablecoin?
US. Yeah. Coinbase, sorry. It's more than 250.
Yeah. So like the question is like if Coinbase is how is it influencing?
Yeah, is it that have an influence on all of this?
Yeah, like I think overall it's like mainstream legitimacy is becoming more like cemented with companies like Coinbase, right? Because they're kind of like the very heavy on compliance and regulatory, kind of being proper organized regulatory wise. So it just makes it such that the general opinion of mainstream is like very favorable of crypto. Everyone's like, oh wow, you have like
There's a big article in the New York Times on like farming now, like all of this, like so to speak, from this side of the fiat going into this space, you know, as a few big hedge funds, you know.
yeah. I mean, yeah, Coinbase is probably overall very good for the space, right?
Right.
Like institutional adoption is often done through Coinbase. Like most of the hedge funds are using Coinbase custody, and maybe it's not so much cypherpunk, but it's like a Web 2.1 instead of a Web 2, right? So
That's
at
what
least
your
one
body-
step forward, right?
That's what your body in Brazil more said to me.
Web 2.1.
Last week, yeah.
Yeah. Cool.
Sweet.
So I have a question on stablecoins. How come I'm not aware of any other, or maybe there are other stablecoins, but the USDT is the most popular stablecoin out there. Is there a use case for other like stablecoins like that's not USDT?
Yeah, there's like so many stablecoins I don't even know about all of them, and different stablecoins have different purposes. So there's stablecoins that already accrue interest by just holding them, like CDAI. So you know DAI?
Yeah.
So Maker has this collateralized stablecoin. USDT is actually not really collateralized. There's like you kind of trust the Tether Institute to have backing for that. Maker came with the concept of collateralizing with a smart contract and minting stablecoin, and then Compound came with this concept of having, maybe it's the first like hot use case in DeFi. Basically, by staking DAI into Compound contracts, you're able to put those DAIs out for lending, and by that generate interest. So like traders will be able to leverage using that, and then your CDAI, Compound DAI, will kind of accrue interest. So this is one. There's synthetic SUSD that we mentioned. There's StableX, Kerman is working on. There's like a ton of stablecoins. Yeah. Personally, I think that actually stablecoin is the most dangerous thing for the ecosystem long term. I think that it's like kind of a transitional step that we need because we're not entirely in the crypto world, but eventually we would want to move away from central bank issued currencies, and we want stability that is not dependent on money printers. But yeah, that's like personal opinion. Any comments or questions?
I just have a general question. Do you have any mistakes, any crypto errors, any funny stories of stuff that happened to you that you thought, damn, should have done such and such?
Yeah, there's the classic one, which is losing a private key, right?
And it's gone? Like,
If you don't have access to your private key, then or the password to decrypt the public key or whatever it is, then you don't have like a forgot my password equivalent.
but you, in your case, you couldn't find it, it's gone.
I had this incident, yeah.
Oh, wow.
So yeah, definitely. This is like a big one. That's why all of the wallets would recommend you to back up your seed phrase, and you have to have like a form of good security. And sometimes also like people would upload private key online or stuff like that. So there's a lot of private key
Yeah,
stories.
out there,
Yeah. Sometimes it's also made up, right? Like speaking of tax, so you hear about those stories where a celebrity that is heavily invested into crypto got hacked and got drained, and then basically they can report losses. So that's another way of doing your taxes.
Get more publicity.
Yeah. Cool. So I guess anyone wants to review? Maybe yeah. There's one more website that I wanted to review.
Actually, I did have a question about the liquidity pools.
Yeah.
It seems like that's the most common structure for exchanges. Is there anything else that is out there that's also popular?
For exchanges or?
Yeah.
I think it's popular because those are decentralized exchanges, right? So someone needs to provide liquidity, otherwise there's no market.
I mean, not like the traditional order book style, like it's in others.
Those are actually not order books, those are automated market makers, AMMs, or constant product market maker. You don't have an order book, you just buy it straight from the curve. There is no, it's always market price, there is no like stop or limit orders there. Now with Uni v3, so Uniswap third version, it's already a little bit more complex, and it allows people to do something more like order book mixed with AMM. There is interesting version though with Bancor. So Bancor is also an AMM, a decentralized exchange, but it allows to provide single side liquidity. And it's a very creative way that they enable it. It's basically the protocol becomes your counterparty to the liquidity, and it mints new tokens. And then if you step out of your liquidity position, it will burn them, and including the fees that it accrued, and then only you accrue the fees. So people are still experimenting in that, and there's a lot of debates on like what would be sustainable at scale and what not, and hacks happen quite regularly and fun times.
So does that mean that the other side, in that single token scenario, the other side of that trade is always the Bancor token?
In their case, yes.
Right. So that means that if people are selling out a Bancor token, you would lose your token and you would get a whole bunch of Bancor tokens instead.
I'm not actually certain about the fees that you're getting or not. I haven't used it, but I think that it's a part of the strategy to encourage people to get Bancor tokens.
I have another question as well about market cap. So with these coins that are only available on the Ethereum network, for example, in a decentralized manner, or haven't been listed on centralized exchanges yet, how is the market cap just a function of what's in the liquidity pool, or how is the market cap then calculated?
Yeah, good question. Basically, you're asking like how is the valuation of the network calculated?
Let's say there's a new token that's being launched, and let's say they upload one of this new token and then one ETH, let's say, to create a new trading pair. Does that mean that the market cap is equivalent to one ETH at that point?
Right. So, yeah, like you're asking how do I bootstrap a market, basically? How do I do price discovery for a new market?
Yes, yeah, and how does this, are there two parts to increasing the market cap of a new token? So it's not just trading activity, it's also got to do with liquidity pool provision. Is that right?
Yeah, there are different ways that it's done, and often when a new project is launching, so they would do a public token distribution event, or ICO it used to be called. It's like a dirty word nowadays. So afterwards some people still call it TGE, token generation event, or liquidity bootstrapping event, all kind of those things, but it's actually the same thing. And the good cases are where it's done in a way that is really helping to propagate the price discovery. And then it's not manufactured, and it's basically like you start saying what the public actually, what's the public demand, and also trading, like you encourage trading by those yield farming activity or whatever. Yeah, that's probably like the good way of doing it. But you can do it also in the way that you suggested. I issue a token and then I go to Uniswap, I create a pair, and I can decide that this token is worth more than a Bitcoin, right? And if there's not a lot of liquidity, like I can provide all of the liquidity and say, oh, look at this like really hot token, it's awesome. That's why when you're trading on a decentralized exchange, you want to know what is the source of your token, because actually there is no limitation on issuing tokens with the exact same name and even the same logo, right? So what you have actually on Uniswap is that when you're using some random tokens before you use before, let's think about, do you have any idea for a token you want to review, or like I'll just use this one. You see that there is I want to use one of the small caps token. So it tells me via CoinGecko. So it means that this is already listed somewhere. And if I trust that CoinGecko, then I kind of know, all right, like there is a curator that has done some work, right? But you don't always have a party that has been curating it. Yeah, this topic has been quite hot. Maybe during the bear market, we're discussing a lot about token curated registries. So you can like create those registries, and now it's already like really hot. It's like you want to rely on registries that are relevant, and then you see even now, because it's permissionless, all those protocols, so it tells me trade at your own risk. Like the interface provider doesn't guarantee anything about this token. Could be the case of some malintentions liquidity provision. But yeah.
You can go to token-based or you can see which exchange says that those are the actual tokens that are verified.
Sorry?
Token-based .org.
Token list.
They have per exchange, they have the list of verified tokens that those are all.
Cool. Yeah. So always use something like this.
Yeah.
CoinGecko is one, CNC is another one, like all of them have, like all of those major ones have it. Yeah, the other website that I want to show you guys is the Stakingrewards.com, and that's slightly different than the yield farming. It's more for proof of stake networks. So for networks that don't rely on proof of work, which I trust that Terry covered a little bit proof of work. That's the way that most popular blockchain networks work, like Bitcoin and Ethereum. And proof of stake relies on validators that are basically doing the equivalent thing that a miner would do, except without having to burn so much energy and compute power. In order to be a validator, you have to have economic stake, and by that basically you put forward a deposit. You lock like a portion of those network tokens, and in many cases this means very high value of those tokens, and you'd risk those tokens being slashed in case that you are you have too much delay in your computing, or you have some corrupt computing or whatever it is. So you basically like stake those tokens to be risked, and you are being rewarded proportionally to how much you stake and how much work you contributed. And in order to incentivize, so most of those people that run staking nodes, validators, they would allow other people to nominate their tokens. So say for example, I'm personally interested in Polkadot ecosystem, so I can choose to nominate my tokens to a list of validators, and then I can see here on this website what's the APY, or what's the reward per year. And yeah, that's another form. You see that the rates here are slightly lower than those crazy rates that we've seen in the yield fund with like 100% APY. It's more like single or double digit. Yeah, I see like the high case here is 16% or 26%. But then there's also the question of what's the value of the assets besides the APY, like what's the actual value of holding that asset. So yeah, you want to think about both.
Are there any functional dApps on Polkadot yet? Or is it just all under development right now?
On Polkadot, there aren't at the moment, but there's on Kusama.
Right,
Yeah, so Kusama is kind of like it's production style testnet, so it's not really a testnet, it's testnet with real economic value, but it's testnet where people are encouraged to try out interesting things. And all of the creative things are currently happening on Kusama, and probably after things would be more fleshed out on Kusama and people would lose money through hacks and attacks, Polkadot would be happy to adopt the things that are more battle tested and are ready for institutional adoption. Polkadot in general is slightly more focused on institutional use case, and Kusama is kind of like the do you know Andrei Kronia by chance? The YM developer. So his tagline is test in prod, which is basically I test in production, I don't do testnet stuff. And there is good rationale for that. When you're looking at development of any DeFi or whatever, on the one hand you can test and you can audit, and you should do it, because once you launched and once people started interacting with it, there's no going back. It's a basically unstoppable machine. But on the other hand, because of composability, which is one of the features of a lot of the primitives in DeFi are, like we call it money Legos, right? Like you build this piece of protocol, someone can integrate it into theirs, and someone can integrate that. And it becomes so complicated to test something that is really mimicking real world environment that many developers are like, I'm not gonna bother, it's just unrealistic, I'm gonna just deploy in mainnet and we'll see if it gets hacked or not, and use at your own risk. So Kusama is kind of a testnet that builders would really love, because it encourages experimentation, but it's not something that is kind of meant for institutions and stuff like that. So it's kind of, there is the testnet where tokens are completely valueless. There is Kusama where it's valuable but at your own risk, and there's Polkadot where it's supposed to be institutional grade of security. That's more or less the rationale there.
Is Kusama more permissionless than Polkadot to develop on? Do you still need the parachain on it or not really?
Yeah, you do. Yeah. I don't know if there's any meaningful difference between the architecture. It's more just like things are being tested there before. It's the same, both are relay chain for substrate. Yeah. All right. Any other final questions or?
Yeah, what is the amount that you can invest in?
Sorry?
$1,000 if you pay $100 in fees per transaction. It's only 10 transactions.